Well, welcome everyone. My name is Maria Cadwalder and I serve as the Executive Director of the Hard Rock Club here at the School of Mines. I am an alumni of the institution, graduated in 1996 with an industrial engineering degree while using the women's basketball team as my vehicle here as I came to college. We are so excited today. CARA, the Center for Alumni Relation and Advancement, and the Hard Rock Club have collaborated to bring you an educational webinar discussing potential law changes in estate planning and how the upcoming election could affect both. 2020 has been no doubt an interesting and unpredictable year that could potentially come with more changes in the next couple weeks. We've invited some expert presenters today that I have the privilege to introduce. First, we have Tyler Wettering. Tyler is a partner at Gunderson, Palmer, Nelson, and Ashmore in Rapid City. Tyler's primary practice and focus are in the areas of estate planning and business transactions. We also have Matt Martin, who is a certified financial planner with Northwestern Mutual Wealth Management. Matt has been instrumental in elevating the Hard Rock Club as he is the acting vice president and a longtime corporate partner. And with that, I'm going to turn it over to Matt to do our next introduction.
Perfect. Thank you, Maria. I also want to take this time to thank Sharon, Leah, and their teams over at the foundation for getting this webinar set up for us. The idea of hosting this webinar was the result of several individuals asking about possible changes coming with the election and to make sure they're maximizing planning opportunities. As a board, we started having this conversation, I think in early October, so for everyone to get this put together in the time frame that we've had is absolutely remarkable. So thank you all. Don't worry, we're absolutely not going to get into politics today, but rather planning opportunities in the current environment. Today's webinar is for educational purposes and we'll cover general estate planning opportunities. Because each individual family and business is unique with different goals and intentions. I'd encourage anyone that wants to talk about their specific situation and goals in detail to reach out to either Leah, Tyler, and or Lindsay. We've set this presentation up to be more of a conversation than a lecture. So please ask questions inside of the Q&A box on the bottom. We'll also have a chat box set up and we'll help answer questions as we go. We want to make sure we're covering topics that you've been thinking about and that have possibly been keeping you up at night. So please don't hesitate to send out a question. Any question we don't get to in today's time slot, we'll make sure that we reach out and help address that question after the fact. Before I introduce Lindsay, I want to make sure that you all know how much we and I appreciate everything you do for Mines and for our students, so whether it's through scholarship opportunities or through a co-op internship or a career opportunity for our scholars. Greatly appreciate everything you do for us. As Maria mentioned, I currently sit on the board for the Hard Rock Club as acting vice president. And because of that, I've asked a friend and a colleague to represent the financial planning aspect of today's talk to avoid any possible conflicts of interest. With that, I'm excited to introduce Lindsay Swenson from Northwestern Mutual out of our Sioux Falls office. She grew up on a farm in Laverne, Minnesota. That's where she met her husband, Casey. She graduated with a double major in finance and accounting, has furthered her education by earning numerous designations, including the prestigious Certified Financial Planner designation. That being said, her favorite job title is mommy to her 2 children. And she has been voted the local best in financial advisors in Sioux Falls for the last 6 years. With that, Lindsay, Tyler, the floor is yours. Thank you.
Awesome. Thank you, Matt. Well, we are excited. Thank you all for being here today. Thank you for your time and taking that with us today. We are going to be doing, again, a conversation around various ideas on charitable giving, planning, estate planning, and on each of these topics, I'm going to be sharing from the financial planning perspective. Tyler is going to be sharing from the legal perspective, and in a few of the topics, Matt is going to jump in as well to share some additional perspectives that he has. So that is our plan today, but again, feel free to ask questions. We want this to benefit you, to provide knowledge and ideas for you as you consider your own personal planning. So the first concept that we want to talk about are charitable remainder trusts. So when we look at what these instruments are, these instruments were created by Congress back in 1969. They are an irrevocable trust that allows you to create an income stream that comes back to you for a period of time, and then the remainder goes to the nonprofit organization, such as a School of Mines. There are a few different types, and we do have some details up on the screen, but in order to qualify, there are some specifications that you need to do. So first, you need to create this trust, and the income coming back to you needs to be for a period of up to 20 years or over your lifetime. The beneficiary needs to be a nonprofit organization, again, such as the School of Mines, and at least 10% of that initial fair market value does need to benefit the nonprofit versus being paid back to you in the form of income over your lifetime. The really nice part about these types of contracts is that you don't have to just give cash. You can give cash, but you also can give appreciated securities, which then avoids you paying long-term capital gains tax on those appreciated securities prior to giving them into the trust. You can also donate real estate into the trust. And again, some of the awesome planning opportunities that these provide is that you can give of these appreciated stock or securities that you have or real estate. If you were to sell them and then give cash into the trust, you would be paying long-term capital gains. But when the stocks would be sold within the trust is tax exempt. So it's going to avoid any long-term gains taxation, which is fantastic, and going to be just, again, allowing you to give with a more leveraged dollar, which is the whole point of our conversation and some of the planning ideas that we want to share today. You do earn a tax deduction, as this is a split interest vehicle, because part of the benefit comes back to you, part of the benefit goes to the nonprofit organization. The amount of that tax deduction is going to be based upon the type of the trust, the terms of the trust, the projected income payments, and some IRS calculations. So that is going to be something that with Tyler and or your CPA that you would need to work through in order to figure that out. But ultimately, these charitable remainder trust contracts are a win-win both for the donor and for the School of Mines, because donors can give an appreciated asset, and the School of Mines gets that full value without the same tax consequences that you would have individually. So those are just some of the background on these types of contracts. They can be a bit more complicated. I'll let Tyler speak to this more. There is ongoing trust administration to these contracts. There's filing of tax returns as well with the trust. And so this isn't the type of vehicle that you would want to utilize for maybe a $5,000 or $10,000 or $15,000 gift. This would be something you'd want to utilize for a larger gift, but can be a very beneficial tool. When we look on the screen, this does give the main breakdown. There are two different types: charitable remainder annuity trusts is the first. This is commonly referred to as a CRAT. Again, this is that split interest gift that allows you a partial tax deduction. The specific thing about the CRAT is that this gives you the ability to make a one-time contribution into the CRAT contract, and then you get a fixed amount each year payable to you over the time period that you specify, with the remaining assets then going to the School of Mines when you pass away. When we compare that to the CRUT, the difference on that is you can make an initial and an ongoing contribution. And the reason for that is this distributes a fixed percentage. So rather than a fixed amount, it's going to distribute a fixed percentage back to you. And there's going to be a formula based upon the balance of the trust at the year prior that determines what that amount is. And so those are the main two types of charitable remainder trusts. that we can work with. So I'm going to let Matt, you had a few topics on this that you wanted to mention as well, and then I'll turn it over to Tyler.
And what we've realized in talking with clients is, depending on goals, obviously, the ability to do what we call give twice intrigues them, it excites them. And what I mean by giving twice is we use these trusts to make sure that our family and our loved ones are taken care of, our heirs, and at the same time have the ability to leave the remainder to our nonprofit. So for example, you've got a $3 million estate between stock options, land, other assets. You've got a $3 million value. If we leave it inside of a CRAT and we create those income payments and we leave, say, 5%, we're giving that 5% over a 20-year period to a charity. And upon passing, that principal plus any interest that's grown, we're able to give to our heirs. So not only are we accomplishing the goal of giving to our charity, but upon death, we're able to make sure that our heirs and our families are taken care of. And then using a CRUT, that exact opposite approach is we're giving to our heirs today with the intent of at death, that remaining balance is going to our charity. So we can ultimately take a $3 million estate or a $3 million estate and turn it into a gift of 6 million, 7 million, right? We're going to assume we get a 6% rate of return. We're giving 5%. So that initial contribution, knock on wood, the market cooperates, we've got growth to it. So we're able to give to both parties. If we've got enough estate to set up both, we can give at the exact same time to both. So one beneficiary is going to receive that income, the other one's going to receive the death benefit, and then we set the other one to work up the exact opposite. So we're giving to our family immediately, we're giving to our charity immediately, taking advantage of the tax benefits, and then upon death, we've got those death proceeds going to the charity, again, as well as our heirs and our beneficiaries. So for the right clients, the right assets, to be able to give twice is very intriguing to a lot of our clients, and I think a very unique planning opportunity.
Yeah, and I would just echo that and say that these charitable remainder trusts, whether they're a CRAT or they're a CRUT, they are a really unique kind of opportunity to make contribution to a charity that you might be interested in, or that's that you support, and still retain an interest. Whether it's a fixed dollar amount under a charitable remainder annuity trust, or whether it's a percentage of trust assets under the CRUT format, you get the advantage of, an initial charitable deduction on the value of the remainder interest that goes to charity, and you still get the advantage of receiving a benefit in the terms of that annuity or UniTrust payment back, whether it's for your lifetime or a term of years, however they're set up. And I think Lindsay did a good job going through a lot of the requirements on these trusts, and because they're a creation, of the Internal Revenue Code, there are some real specific requirements that have to be met in making sure that they qualify as either a charitable remainder annuity trust or a charitable remainder UniTrust. For the most part, they're the same, and Lindsay touched on a lot of them. Is in order to qualify, first of all, the value of the remainder interest has to be at least 10% of the initial contribution made to the trust. And for the most part, that's pretty easy to achieve. However, you can run into some issues if you have like a particularly young trust beneficiary, where the term of the trust is set over their lifetime. You might not meet that 10% requirement. The other, requirements with an annuity trust is it pays you a specific dollar amount that's determined when the trust is funded, and there's limitations on that. So that amount has to be at least 5% of the initial contribution, and no more than 50% of the initial contribution. And the variation, in between those percentages is going to have a big impact on the value of what that remainder interest is, and therefore a big impact on the amount of the charitable deduction that you get to take. For the most part, a lot of the requirements are the same. The one thing that was noted on the initial slide is that with a CRAT, with a charitable remainder annuity trust, there can only be one, that trust can only be funded once. So there can only be one contribution made to that trust. With the caveat that if it's funded at death, it could be funded from multiple sources, life insurance or retirement accounts or whatever, that were triggered by your passing. But if you're going to plan on making additional or multiple contributions, you might choose a CRUT instead, rather than have to form an individual annuity trust every time you want to make a charitable contribution and retain an annuity interest. But for the most part, the individual setting up the trust or their relatives or really anybody is a permissible recipient of the income payments. It's a requirement that a qualified charity be the remainder beneficiary, and then it's required that whether it's a UniTrust or an annuity trust, that payment be made every year. Kind of the unique, I guess, function of a UniTrust is that because the distribution is a stated percentage or a fixed percentage of the trust revalued every year, there's the opportunity that as those trust assets appreciate, the payment will potentially increase as well. That as the trust principal grows, the UniTrust payment will grow, where with an annuity trust, the payment is set in advance and it's going to be what it is, regardless of whether the trust assets appreciate, but then, sort of guards against that downside risk as well, that if trust assets depreciate, that annuity payment is, set in advance. So I guess whether, your specific circumstances, might dictate that, one might be a better option for you than another. But they are a really unique vehicle for those individuals who are charitably inclined.
I have a question from a participant, from Bill. He wants to know if there are more than 2 types of trusts.
There are absolutely more than 2 types of, I guess, trusts in general. With these charitable remainder trusts, there's a third variation on the CRUT. It's called a NIM CRUT. So it allows you to take either the lesser of a fixed percentage or the income generated that year. But as far as charitable remainder trusts, you're either looking at, the general structure of an annuity trust or a UniTrust, with some minor caveats. Although there's all sorts of, other trusts for different purposes out there as well.
And I have another question asking if a current annuity investment can be converted or rolled into a charitable trust.
I believe oftentimes existing annuities can be contributed to a charitable remainder trust. I don't know if Lindsay or Matt have anything that they want to add there.
Yeah, I think it's going to depend on the type of annuity. There's a lot of different types of annuity accounts out there. And so it's going to depend on the structure. Is it in a retirement account? Is it a non-qualified annuity? What's the verbiage around the annuities? There's some that are more in like accumulation phase and some that are in payout phase. So I would say it's going to depend on the specifics of the annuity, but that could be a question that one-on-one we could help with.
And then another option outside of putting in the states, a life estate inside of one of these annuities, is a life estate. So if we've got property, land, building, a residence, and our intent is to give that to a charity. And I know I'm from Northern State, and this actually just happened, and they just received I believe it was a $40 million estate through this planning option. Is they transferred the deed to that property or to that land directly to the charity while reserving the right to use it. And you can use it for one life or two life. So you can do your life, your spouse's, you can do just yours. There is some flexibility there. Owners of the property are still responsible for maintenance, taxes, insurance. They still have access to use of that property. Benefit of not only living in the property or maintaining the rights to live in the property is you get a pretty substantial, or could be pretty substantial, charitable income tax deduction, which is beneficial. We assume we'll use land valued at $1 million. So a lot of our East River friends with valuable land are using this approach. We've got land valued at $1 million. We get that immediate charitable tax benefit today. We reside in it, and there's a formula to determine how we calculate that immediate charitable tax benefit, taking into account current value, projected value, life expectancy, and your accountant can help you determine what that tax credit is, but it can be, or deduction, excuse me, can be pretty substantial. Assuming some growth, we've got $1 million life estate, land, it grows in value. We get the immediate tax break upon passing. That asset now becomes property of your charity. So another planning opportunity outside of putting in a trust is just immediately transferring that deed while maintaining ownership rights, use rights.
Perfect. Thank you, Matt. The next area that we wanted to talk about giving is in the form of life insurance. So with life insurance, you can utilize a new contract or an existing contract that you've purchased years ago. But life insurance was designed as a way to transfer wealth when you pass away. And it's one of the most efficient ways to do that. And so we just wanted to touch on how you would use life insurance also. And so again, you can utilize an existing contract or purchase a new contract, but essentially what you're doing is you are naming the nonprofit of your choice as a full or a partial beneficiary. The big deal on life insurance is that when you pay into a policy, you are generally paying in 10 cents or 20 cents or 30 cents to get $1 back tax-free. So all of the difference in between the premiums that you pay versus the death benefit that comes are entirely tax-free. The IRS has protected the tax code in relation to life insurance, and it hasn't changed over the years. It's one of the best protected areas of the tax code due to the social benefit of life insurance and what it does for families. And so we utilize this concept, or it can be done very much so, just with, again, the ability to leverage your dollars. So you're not giving a dollar for dollar contribution, you are giving 10 cents, and then the charity or the nonprofit would get $1 at the point when you pass away. So that's a big thing there. We're also seeing a lot of individuals do what we call a joint life or a second to die contract. A contract like that is going to provide more leverage on your dollar. And the concept behind that is that you put the policy on both a husband and a wife together, and it will pay out at the second passing. And so that is a way to utilize a life insurance contract to further leverage the dollars that you are working with in terms of that. Again, you can name, you could take a contract and name your family or your heirs as a partial beneficiary, as well as a nonprofit of your choice as a partial beneficiary, and that can be changed at any time. So there's a lot of great planning opportunities with that. The other thing that we're seeing a lot is as people's estates are growing, they're concerned about estate taxes. And we're going to touch on this more later, but you can purchase a life insurance contract within what we call an ILIT, which is an irrevocable life insurance trust. And when you purchase a contract within an ILIT, what that does is the death benefit that comes out stays outside of your estate. So that does not go into your taxable estate when you're doing your estate planning or your estate tax calculation and figuring that out. So from an estate planning perspective, as well as an ability to give with a more leveraged dollar, life insurance is a very commonly used technique to be doing some of the giving that you're wanting to be doing. Tyler, I will turn it over to you.
Could I slip in a question here? We have a participant asking if CRAT and CRUTs are excluded from the estate value when you're considering state estate taxes.
Tyler, that's more in your area. I'll let you just touch on the detail around that if you want to.
Yeah, so the transfer to that to a CRAT or a CRUT, the remainder interest would not be includable in your estate anymore. The annuity payment, potentially that was made could be, but with that charitable deduction, the remainder interest wouldn't be. And touching on, I don't have much to comment on the life insurance, other than Lindsay did mention the concept of an ILIT or an irrevocable life insurance trust, which we you used to see a lot of when the estate tax exemptions were relatively low, and you've seen less and less of as they've grown, because like Lindsay said, the death benefit for life insurance is not taxable to the recipient, but it is includable in the owner's estate for federal estate tax purposes. And we'll talk about this a little bit later, but we're at kind of in a climate right now where there's a lot of uncertainty around the federal estate and gift tax exemption, that where you might see ILITs coming, more into fashion and being used more so, because when you set an ILIT up, it's established so that the trust is the owner of that life insurance policy, so it's not included in the insured's estate when they pass away. So that is something that, depending on how the estate tax exemption moves here in the future, or what the climate looks like, that you might see an increased use of.
And one thing to finish off on life insurance from a planning opportunity standpoint, when we're doing distribution planning for our clients, looking at how are we creating the income we need in retirement, and we run our analysis and the scenarios, and then we build into RMDs and 401ks and IRAs, when we're running into clients who are saying, okay, I understand I have to take this money out, and Lindsay's going to touch on RMDs and what that means here in a little bit, but when we're running into clients who are generating the income they need in retirement, and then all of a sudden at age 72, the IRS is knocking on their door saying, okay, it's time for you to start taking these taxable assets out. We need to start generating some tax dollars from you. Our clients become concerned, and not only from a tax standpoint, but I just don't need this money. What are we going to do with it? One option is what Lindsay was talking about, is we'll take that RMD, if it's $25,000 a year, we don't need that income. We'll look at leveraging those dollars to put inside of one of those second to die or joint life contracts, and using pennies to leave dollars. So we're contributing $25,000 a year from these RMDs that we just don't need anymore into this life insurance contract that upon death is going to leave millions. So we're leveraging those dollars that we don't necessarily have to have, but have to take to leave a bigger impact to an organization, a charity, someone that's had an impact on our lives. So there are other options from an income standpoint to get into life insurance if you don't have an existing contract in force today.
Just to follow up on Matt's comment there as well. So we're doing that for individuals a lot lately, it seems like. And when you look at life insurance, the conversation that we're having and the way that we're viewing this is we take a look at the dollars that you're putting into the contract, which you have to be investing and putting somewhere. And then we look at what's the death benefit that's going to pay out upon your passing or the passing of the second individual. And when we look at the internal rate of return, just comparing the dollars funding into the vehicle and the death benefit that pays out over a long life expectancy, for a lot of individuals, it's a very competitive rate of return compared to putting the assets into a balanced risk investment account. But it has a lot less risk. And so we're taking risk off of the table and creating that growth in a tax-free capacity. And so it's a very common planning tool, especially if you do have excess income in retirement. And we're going to parlay that into some of the IRA functions that we'll talk about here in just a minute as well. But yeah, it can be a very powerful tool, and that's exactly what it's designed to do. And just interrupt Leah if there's any questions. Our next topic is on appreciated stock and securities. So this is a commonly used strategy that I think a lot of people are aware of, but some might not be. And so I want to give the example. Let's pretend that you bought Amazon stock 5 years ago. Amazon stock 5 years ago cost you about $600 per share. Today the markets are not doing so well. But when I checked this morning, the current price was almost $3,300. So that if you sell your Amazon stock in a non-qualified account, if you've held it for more than a year, you are going to pay long-term capital gains tax rates, which depend on your income level, for that $2,700 per share gain in your Amazon stock. And so if you were to be doing that, but then turning around and giving a cash gift to any nonprofit, whether that's a School of Mines or anybody, you're losing out on some of the potential tax favored giving that you could be doing. So rather than just giving cash, you could give your appreciated stocks, stock shares in Amazon or any other companies that you own. And so you could give the stock. And when you do that, you avoid having to sell the position, pay the long-term capital gains tax rate, and incur that. So in my example of Amazon stock being now $3,300, you are giving a $3,300 gift to the nonprofit of your choice, but you only paid $600 for that share that you're giving. And so essentially when you do that, you are avoiding all of the taxation on that. You're still able to give the larger gift that you want to, but you're not having to do so in a dollar for dollar capacity. It's another way to leverage your dollars, take that growth, give with as many tax benefits are available within the IRS tax code right now. So when you're doing that, you do need to work with your advisor. You need to work with the organization to make sure that the shares of stock are transferred, because again, they are not sold and then the cash transferred, the actual shares of your stock are transferred. So there's a few additional steps to it, but at the end of the day could avoid a lot of potential tax and is a great way to consider doing gifting throughout your lifetime. Again, this is for non-qualified accounts. This is not for stock held within an IRA, Roth IRA, 401k, or vehicle like that. We'll touch on that next. This would be for your non-qualified accounts. So the other note that I want to make too is that this would apply toward employee stock options that people have accumulated through portions of their income over time as well. So this is going to be stock that you purchased or the ability through stock options that you have as they vest.
And one thing on this, Lindsay, you mentioned capital gains. The top tax on capital gains currently is 20%. And as we know, tax structure could change at any time. We are hearing some rumblings that the IRS is looking at changing the capital gain structure based on your net worth and changing that to an income tax, which in 2020, the highest income tax bracket is 37. So we are hearing that they're looking at possibly making a change and changing that from a capital gains max out at 20% to possibly having to claim that as ordinary income.
Yeah, and that's how they treat short-term capital gains right now. If you have held the stock for less than a year, that's going to be a short-term capital gain, which is then going to be taxed as ordinary income. So if you hold it for less than a year, you're paying ordinary income. More than a year, you're going on the capital gains tax chart, which, yeah, as Matt said, is subject to change at any time, but especially being looked at heavily right now.
And we do a lot of work with School of Mines alumni, grads. We do a lot of talks, and we're seeing a lot of companies offering gift option or stock options. We're seeing stuff gifted. So I think this really plays into our alumni. You know, we're 3M, Boeing, Raytheon. We're seeing a lot of clients who are getting closer to retirement, wondering what do we do with all these stock options we've exercised. So I think it's a really good planning opportunity for a lot of alumni at school lines.
Yep. And all of that and all of everything that we're talking about comes back to your personal plans. So the way to make decisions around this is to look at your personal plan and look at what you want to be doing from a giving perspective, and look at what you need from retirement income, and look at what you want to leave for a legacy for your family, and to look at your personal situation and then make decisions from there in terms of what makes sense based upon your personal plans and everything from that perspective.
And on that, one more thing, sorry, Lindsay, and then I'll let you move on to IRAs. I would encourage anyone who is currently giving or wants to give, make sure you're having a conversation with that organization or charity, and make sure they understand why you're doing it, what you want to have accomplished. Have an in-depth conversation on why it's important to you, what you're trying to accomplish, the purpose of it. And leverage Leah and Tyler and Lindsay to find the most efficient way to do it. Again, I would encourage everyone to make sure people understand why you're doing what you're doing. We want to hear your story.
Awesome. Thanks, Matt. The next area that we want to talk about is IRA distributions. And we broke this down into IRA distributions while you're living and then after you pass away, just to kind of touch on it from both perspectives. So while you're living, when you hit age 72, you have to take out so much of your IRA per year. It's called a required minimum distribution. And essentially, you've been receiving tax deferral on the gains ever since you put the money in, and it was a deduction initially on. And so the IRS just wants their tax revenue on these dollars is ultimately what it comes down to. In 2020, it did change from 70.5 to 72. And just a side note, in 2020, all required minimum distributions are waived if you haven't read that. So just as kind of a public service announcement. But once you hit 72, traditionally what people would have done is take money out of the IRA, count it as income, get your 1099, and then write a check to the organization of your choice, which now, in order to receive the deduction, you have to itemize your deductions, which when they doubled the standard deduction a couple of years ago, that got harder to do, and not everybody qualifies to itemize anymore. And so once you hit 72, what you have the ability to do is what we call a qualified charitable distribution. What that means is rather than you getting the IRA distribution check sent to you, putting it in your bank account, and then writing out a check to the organization of your choice, you have the check go straight from your financial institution to the nonprofit that you want on behalf of you. So the check is sent to you so that way you can still personally give it to the organization, but it's made out directly to the organization like the School of Mines. When you do that, you do not get a 1099 for the income and have to recognize it as income and then hope you can deduct it through itemizing your deductions. So it makes it very clean. It's very easy to make that transition of those funds if you were going to give them anyways. It's much more efficient than just giving cash or taking the funds as cash, paying the 1099 income, and then giving. On the qualified charitable distributions, the maximum you can do is 100,000 per year. So there is a max, but we've got a lot of clients where, you know, if their RMD is, let's say, $25,000 or $10,000 or whatever it is, they may take, you know, let's say half for personal use, and then give half to the nonprofit of their choice. And so it can be a partial split to meet your RMD requirement. It can be all of it one way or the other, but it's just an efficient way that does require a little bit of pre-planning to know, you know, where the check needs to be made payable to directly from the financial institution. So in 2017, with the Trump tax reform and doubling the standard deduction, that made it a harder for a lot of people to itemize, and this became that much more important after 2017. So we have a lot of clients who are able to take advantage of this and give again in the most tax efficient manner while they are living.
And one change in 2020, and it's not a big one, like Lindsay mentioned, you have to itemize to get these benefits. In 2020, you can now get what we call an above the line deduction of up to $300. So if you make a charitable gift of at least $300 or more, you get an instant deduction of $300. You don't have to itemize. It's not a huge number, but just make sure in 2020, you know that you do get an above the line deduction up to $300 for any gifts to a nonprofit.
Thanks, Matt. Yep, perfect. There were a lot of changes to IRAs that occurred this year. Also, if you distribute the proceeds to death or at death to anyone other than your spouse. So what it used to look like prior to 2020 is if you pass away, the balance of your IRA generally goes to your spouse. They can take lifetime required minimum distributions, again, stretched over their lifetime. That did not change, but if you are the second to pass and now the assets are going to your kids, or maybe they're going to a sibling or something of that nature where it's a non-spouse beneficiary, that changed from having that same advantageous stretch required minimum distribution time frame to being scratched into a 10-year time frame. So now, if you are a child or any other non-spouse beneficiary and you inherit those funds in 2020 or beyond, you have to take a look at the balance when you inherit the funds, and now you have a 10-year time window to spend down those dollars. This, I mean, obviously kids are inheriting the money, and that's great. And there's a lot of good benefits of that. But if we think about the situation in reality, I'll share with you a situation that I ran into in the last month. So I've got a mom and dad, they've got an only child. They are pretty conservative spenders. They've saved a lot over their lifetime and built a lot of their value within their 401k. They've seen some great growth in it. So now that's they're retired, that's moved into an IRA, but we did their retirement projections, looked at what they're going to be spending, where they would be spending it from, in built-in conservative rates of return, all of these different variables that are impacting their future, and played it out through their age 90. And at their age 90, there was going to be about $2.6 million left over in their 401k when they would be passing away. Again, after taking RMDs, after spending every dime that it was that they wanted to spend to travel and to do what they wanted to do and enjoy the lifestyle that they wanted to have. So then we take this $2.6 million and their son, who would likely be 50 to, maybe 45 to 65, let's just say, whenever they pass away. So he's successful. He's on his way to being in one of the upper income tax brackets himself based upon his trajectory and where he wants to go with his life right now. So then he's going to be inheriting this $2.6 million asset that he needs to distribute within a 10-year time window, which is going to add, let's say, $260,000 to $300,000 into his taxable income on a yearly basis when he's already at the max tax brackets based upon his career. So now the parents have deferred the tax over those years, and that's fantastic. But now that asset is likely going to be taxed at 40% or 35% or somewhere in those upper income tax brackets by their son when he is inheriting those dollars. So what we looked at is when you're looking at doing your planning, we suggested they're in fairly low tax brackets based upon their more conservative spending, much lower than 35 to 40%. So we actually suggested to them that you should think about proactively spending some of this IRA money and or taking a distribution to fund a life insurance contract and or doing Roth IRA conversions, something to pay some of that tax today, so that way not so much is going to be left to your children as a beneficiary. And so as it relates to charitable gifting, when we kind of circle this back, we've been having a lot of clients where we've been telling them, let's take your IRAs, put the charitable organization or the nonprofit like the School of Mines as a beneficiary of your IRA account, still do the other planning that you were thinking, but put your family or your heirs as a beneficiary of the life insurance and put the IRA beneficiary as the nonprofit organization. So take what's going to be taxable, give that to an organization that's tax exempt, and then give the tax-free high growth assets like the Roth and the life insurance or non-qualified accounts and give that to your family. So you can be very strategic about what goes where and what's going to avoid the most tax. But this was a very significant tax change with this 10-year 10-year requirement for non-spouse beneficiaries. And it hasn't actually got a lot of attention. So it's been something that we've been educating our clients around, really just identifying with them, what are your giving goals? Let's see what your retirement income looks like, and let's make sure we're giving to the nonprofit from the best source of those dollars. So Matt, if you want to add anything there, or Tyler as well.
Yeah, sure. I would just echo, what Lindsay said is the changes that were made for non-spouse beneficiaries under the Secure Act, limiting their time period to take those distributions to 10 years. It's huge, and it is something that a lot of people don't know about. And we're trying to educate people as well, because I think the example she gave is a great one. You potentially have the child who's in their peak earning years, in their 40s and 50s, who now, rather than be able to stretch those required minimum distributions over their life expectancy, which might be 20, 25, 30 years, now have to take that over 10 years, and it's subject to ordinary income tax rate. So it is something that people, especially who do have intentions of making contributions to charity, look at their assets and like Lindsay said, try to be strategic in identifying which assets you leave to certain individuals, knowing that if you leave these tax deferred retirement accounts to charity, that they're not gonna have that same income tax hit that a child or other non-spouse beneficiary is going to have. The other thing that we're seeing somewhat of, and it's, I don't know if controversial is the right word, but is people trying to replicate that stretch feature by using the charitable remainder trust that we discussed initially, that leave the qualified or the tax deferred retirement account to a charitable remainder trust that has, a lifetime or a 20-year term with the child as primary beneficiary, with the School of Mines Foundation as the charitable remainder, and you're able to somewhat replicate that stretch feature where your estate's going to get an income or a charitable deduction on the value of the remainder interest. The child's still going to have to pay income tax on those distributions as they're made, but they're able to make them over a longer period of time. And then when the School of Mines or whatever other charity gets it at the end of that term, they're income tax exempt. So it is. We are seeing that kind of as touted as being a way to kind of replicate certain aspects of that stretch feature that went away under the Secure Act.
And then Lindsay mentioned giving IRA distributions while living, right? Giving them directly to the institution. You can do the same thing with an inherited IRA. So if you're the beneficiary and you've inherited an IRA and you've got one right now and you're taking RMDs out, you can absolutely take advantage of that gifting option and give that inherited IRA directly to that nonprofit, again, up to $100,000 per year, and avoid that tax. So IRAs as well as inherited IRAs.
Yeah, just to add on that, Matt, anytime that you have a required distribution is when you have that ability to do the qualified charitable distribution. So perfect. The next area, and Tyler, I'm going to let you touch on this more, is the CARES Act.
Sure. So there were just a couple of things under the CARES Act, which was the Coronavirus Aid, Relief, and Economic Security Act. There were some aspects of that changed certain things for charitable deductions. And Matt mentioned earlier, one of the changes is this new $300 above the line deduction for individuals who don't itemize. So if you take a standard deduction, if you make a charitable contribution, you can deduct, up to $300 from your adjusted gross income and still take your standard deduction. So it is a benefit that wasn't there prior to the CARES Act, and then one of the few charitable deduction rules that last beyond 2020. It'll continue in the future. One of the big concerns was the decrease in charitable contributions made, due to the coronavirus pandemic and the slowing of the economy and things like that. So one feature of that is for charitable contributions made in the year 2020, individuals can now deduct 100% or offset 100% of their adjusted gross income. Previously, you were limited to 60% of your adjusted gross income, and then any excess you could carry forward for 5 years. For contributions made in 2020 by individuals, you can offset 100% of your adjusted gross income. Any excess you can still carry forward for 5 years. But the thing that needs to be noted, and that's at the bottom of the slide, is that the increased limit applies only to cash donations. So if you donate appreciated stock or any other asset, you don't get the benefit of the CARES Act increase. So this is maybe the one situation where it makes more sense to donate cash than it does appreciated assets. Although you'd have to look at, how much appreciation was there and what, potential tax liabilities might be. But it is an opportunity for individuals who are currently making charitable contributions to offset 100% of their adjusted gross income for the year 2020. So just something I thought should be brought to everybody's attention.
Thank you, Tyler. And the last note that we wanted to touch on, and again, we have zero intention of making any political statements. That's not what we're trying to accomplish. But what we wanted just to talk about is obviously with this election or the election in 2024 or the election in 2028, any future election, the people in office are going to change. Both parties have different views on taxation and which way things should go to some extent, and changes that they would like to see made. The income taxation, estate tax exclusion, both of those things are being talked about a lot. And we just wanted to mention this from the standpoint of any changes to income taxation, capital gains taxation, the estate tax exclusion, all of those factors, those are going to impact all of the things that we have just shared with you. They will make them more or less beneficial depending on a person's tax rate, their income levels, what they have, all of those types of things. In general, if we see a sweep of one party, regardless of which party getting into the White House, Senate, and the House, we're going to likely see bigger, more impactful changes. If we see a mixed Congress where we have one party controlling the House and the other controlling the Senate, we're going to see much more gridlock and probably less impactful or less substantive changes occurring. And so from that standpoint, we just wanted to note that taxes are something that they're being debated this election, but they're debated at every election. And I just want to remind you as well is, so the last major tax reform that we saw went into effect December 22nd of 2017, so not even 3 years ago, and that was the Tax Cuts and Job Act that Trump enacted. And with that, he brought down the top marginal income tax bracket along with some changes throughout the tax brackets. And it also doubled the estate tax exclusion amount from the 5.49 million up to 11.58 million. And that's going to continue on through 2025, through the end of the year. But as of January 1st of 2026, as current law sits, those personal or individual tax changes are set to sunset and go back to where they were before. So should nothing change, that is a for sure, that's going to change anyways. And so just at the end of the day, we just want to talk about tax laws are constantly changing. They're always up for debate, whether it's election time or not election time. It's something that is always being reviewed and contested. I know Matt put together some specific information just on the history of taxes. If we look at things in general, we are not in a very high tax bracket if we look at our entire country's history. So we just wanted to remind you on all of these things, that the strategies that we're giving are the effectiveness from an after-tax standpoint will change based upon what the tax code is, but the tax code is always subject to changes.
And we're encouraging clients to be proactive, not reactive. We know what the estate tax is today. We don't know what it's going to be tomorrow. If there is any concern that we could run into an estate tax issue down the road, if there are big sweeping changes, let's be proactive about it now and look at having conversations with Tyler or Lindsay and finding the strategies to protect our estate. So we're always proactive, not reactive. Interesting stat I got from one of our wholesalers, MFS. The United States government has maintained financial records since 1789. As of September 30th of 2010, we reached national debt of 13.56 trillion. As of this October 15th of 2020, our debt has increased to $27.14 trillion, meaning in the last 10 years, our debt in the last 10 years is higher than that debt in the first 221 years. So do we anticipate tax changes? Absolutely. Today, the top federal income tax marginal tax rate is 37%. In 1979, the top marginal tax rate was 70%. In 69, it was 77%. And the highest it's ever been has been 1963, where we had a top marginal tax rate of 91%. So Lindsay's right. Taxes are fairly low considering where they have been in the past, and our debt is increasing at a pretty high rate. As far as estate tax, currently in 2020, federal estate tax is set at 11.8 million and taxed up to 40% above that amount. To give you an idea of how often and how big a changes we can see, 19 years ago, that federal estate tax was 675,000. So in 19 years, we've gone from 675,000 to 11.8 million. And that can change at any point. The tax above that 675 in 2001 was 55%. So today, 11.8 million taxed at 40%. In 2001, 675,000 at 55%. So again, it comes back to being proactive and not reactive. Are we anticipating estate tax limits to go down to that 675,000 range? Absolutely not. Could it go lower? Absolutely. In fact, it will. So just to give me the perspective of where we are from a debt standpoint, income tax brackets, as well as the state tax brackets.
Tyler, did you want to add anything from your perspective on that?
Just briefly, I guess that, and just to kind of reemphasize what both Lindsay and Matt said is, earlier, I think I said, we're kind of in a uncertain time as it relates to the, federal estate and gift tax exemption. That's due not only to the fact that the current law is set to sunset, like Lindsay said, January 1, 2026. So the existing law says, January 1, 2026, the rate goes back to what it was before. $5 million indexed to inflation. It'll probably go from 12 to 6. So overnight, everybody's going to lose, potentially $6 million in federal estate tax exemption as the law currently sits. Like you said, depending on the outcome of the election and the discussion you hear is that you hear the number 3.5 get thrown around a lot. That the Senate and Congress and the White House all change and they're able to make those changes. I think the earliest they could be made would be effective January 1, 2021. So you could be in a situation where you go from, today having 11.58 million in exemption to a situation where it could be significantly less than that, and it's just something to be aware of. And if you are someone who is currently has an estate that isn't subject to federal estate tax, but would be, if the exemptions are cut in half, or if they're, cut even further than that, you should be looking at, potential opportunities that might be out there right now to take advantage of the exemption while it's known and while it's at, an all-time high, really. So it's just something to be aware of, and like Matt said, to be proactive, not reactive in watching how these laws could change.
Right. I mean, something might not get passed until July from a tax standpoint, but we can all but guarantee that that's going to be retroactive to the first of the year. So that's what I mean by be proactive, in that it may not be talked about or implemented until July, but they're going to make it retroactive to the first of the year.
I just want to have a follow-up note on that. The best way when you're looking at being proactive and your work with a financial advisor and so talk to the financial advisors that you have, talk to us if you have questions, but the best way to look at this, I've seen this in a lot of situations where people might not be in a situation where they're above that estate tax exclusion today. But when you look at the assets that people have saved for retirement, and you look at their spending and really dive into what it is that they expect is going to change for them over retirement, a lot of individuals are in the position where their net worth is actually growing during retirement, where they are just spending some of the interest. They are not even really tapping into the principal, and it's not what they anticipated, but they've been such good savers over their entire lifetime, and maybe they inherited some money. Lots of different things could have happened to where they're now in a position that their net worth is only going to be increasing over their retirement years rather than decreasing. Either that, or maybe it's where there's a lot of land and business value that's going to be increasing. So maybe the financial assets are decreasing because you're spending through those, but you're not selling those actual tangible assets of the land or business or other things. And the increase in those is offsetting the decrease in your financial assets. And so from a proactive standpoint, you want to be looking at doing projections to say, okay, well, here's where I'm at today. I just recently had this example. So, because the total, if you add up 11.58 million per person, we're at 23.16 million total as of today's value. And I was recently working with a client, their net worth is about $15 million. So they felt really good. They're right on track. They're under the amount, obviously lower, above what it would be when it goes down in 2026. But we analyzed the future net worth of their estate, and their net worth was only growing and likely was going to be in the ballpark of double up to that $30 million standpoint by the time that they passed away. And so because we did that proactive planning, we're having conversations now to look at, what can they be doing? What charitable giving can they be doing? What trust work can they be doing today? What insurance planning can we be doing today? What can we do now that prevents this huge estate tax bill down the road? And so we're considering all sources, their charitable giving along with everything else that they want to be doing. But proactive planning to look at that now and look at how it's going to change over the next 10, 20, 30 years is very important to keep in mind at the same time of just what the value is today. And with that, that is the information that we prepared. I know we're just right at a little over an hour. And so our plan was to go through this information. And Leah, if you want to jump in, I know we've got more time for Q&A if we want now, but yeah, that was the information we had put together for today.
Yes, we do have some more questions. The first is a two-pronged question. The year in which a person turns 72, is it correct that they must take an RMD probably by April 15th of the next year?
So it used to be what the rule is in the year that you turn 70 and a half, you had to take your RMD by April 1 of the following year. But if you did not take your first required distribution until April 1 of that following year, you still had to take the following year's distribution in the same calendar year. So then ultimately, if you waited through April 1 of the following year, you had to take 2 required distributions in that first year. So it would be a double up there. I believe now, and I need to double check and I can, but I believe now it has to be in the year that you turn 72. You have to take your first distribution that calendar year, to my knowledge.
Okay, thank you. And
Yep.
the other part of the question is, if a person cannot beat the standard deduction, it seems that the QCD from an IRA seems to be more tax efficient than donating appreciated stock. Is that correct?
So if you do the QCD from your IRA, what you're going to save there is ordinary income tax, because the IRA distribution would be taxed as ordinary income. The appreciated stock is going to be taxed at long-term capital gains tax rates, which typically are going to be less than ordinary income. So we would have to sit down and review your specifics. But generally speaking, being that the capital gains tax rate is lower than your ordinary income tax, yes, the QCD from the IRA would give you a bigger benefit from a tax perspective than appreciated stock if you have that capability. Yep. Good
Thank
question.
you, Lindsay. I have another question here. Is there an annual limit amount value for appreciated stock designated as a donation to SCS-M&T without personal tax?
Not that I'm aware of. I don't know, Tyler, from your perspective or Matt, but not that I'm aware of. I guess just to add more to that, it would just be the maximums of charitable gifting in general on your tax return.
Tyler, does that come into play, the 100% of? Oh no, that's cash. Sorry, never mind.
Yeah, because the QCD maximum is 100,000. So yeah, it would just, I mean, it's going to be in relation to your income. And so I would work with your CPA. I mean, your CPA is going to be the person going through your tax return with you. But to my knowledge, you're going to want to offset income. So yeah, I guess not to my knowledge.
Yeah, I would say there's no upward limit on what you could give, but if it's appreciated stock, you're only going to be able to, there's a limit on how much of your adjusted gross income you can offset, and then there's a limit on the amount of time you can carry that excess forward. So when looking at those and the dollar amounts, you don't want to, I want to say you don't want to, but there might be more efficient ways of spreading that out when you consider those limitations.
I just wanted to let any of our participants know that if you have further questions, you can go ahead and type them in and we will ask our panel to answer them for you. In the meantime, I wanted to let you know that the Center for Alumni Relations and Advancement does manage charitable remainder trusts in-house. And we also gladly accept people that want to name us as a beneficiary of any of their IRA plans or different accounts. And I wanted you to know too that you can designate what you would like to support at the school with that. For example, if you want to start an athletic scholarship, you're more than welcome to do that. Or if you want to set up something to support a certain department, we like to do what you want to do with your money. And so you could contact me and we could work up a gift agreement to make sure that your wishes are known and that we follow exactly what you want us to do. If there are no more questions here, I want to let you know that, I'm sorry.
I accidentally deleted a question. It was in regards to CRATs and CRUTs and the complexity of them, asking if we had additional information, and it was sent from an anonymous source. We do have an advanced planning department in our home office in Milwaukee. We can find some pretty good information on the CRAT, the CRUT. We would just need to know where to send it. And unless, Leah, you see the question somewhere, but we would need to know who to send that to. If you could let Leah know, we'll get some information emailed over to you.
Yes, I'm happy to field any questions that people have. If you want to email me, my email address is leah.mahoney@sdsmt.edu. This has been a recorded webinar, and we also will be posting that on our website. So in case you want to go back and review anything that the panelists said, you will be able to do that. I want to thank Lindsay, Tyler, and Matt for your time today. We very much appreciate your donating your time to us. And we direct anybody that's listening to contact one of them as well if you would like to. That would be great. Thank you to our participants for listening to us, and we hope to do more of these in the future. Thank you.
Thank you, everybody.